Most people stare at numbers on a balance sheet the same way a parrot looks at a clock. They can see it, but they have no idea what it means. The tragedy of modern investing is that people know how to read, but they don't know how to think. The real secret isn't memorizing accounting formulas. It's learning to interpret what those numbers say about the behavior, character, and future of a business. Most people think reading a balance sheet is about memorizing accounting terms, but that's where they go wrong from the very beginning. The truth is, those numbers are not just cold figures sitting on paper. They are the living history of a business. Every number represents a decision someone made, an action someone took, and a consequence that followed. When you look at a balance sheet, you're looking at how human nature expresses itself through money. The numbers are only the language. The meaning lies behind them. If you can understand that, you'll stop seeing a balance sheet as a financial report and start seeing it as a story of behavior. A company's assets tell you what management values. Its liabilities tell you how much risk they're willing to take. Its equity tells you how disciplined they've been over time. These are not random results, but reflections of habits and decisions made day after day, year after year. Some companies show you ambition through steady asset growth. Others reveal recklessness through mountains of debt. And some quietly display wisdom by maintaining strong reserves and modest leverage. The key is to interpret the tone of the story, not just the plot. Numbers will never shout, but they whisper clues to those patient enough to listen. Think of a balance sheet as a behavioral X-ray. When you examine it closely, you start seeing the fingerprints of every decision ever made by the people running that company. A business that constantly borrows to fund its operations tells you something about management's impatience or lack of discipline. A company that builds cash reserves and reinvests wisely tells you about prudence and foresight. What you're really measuring isn't profit, it's rationality. You're studying how people handle temptation, pressure, and opportunity. And over time, those behaviors either build empires or destroy them. That's why the balance sheet is not about math. It's about psychology and behavior written in the language of accounting. The numbers are a mirror reflecting character. The real skill is learning to see past the surface. Every figure hides a motive. When a company inflates assets, it's often driven by ego. When it hides liabilities, it's often driven by fear. When it retains earnings instead of distributing them, it's often driven by ambition or long-term thinking. A great investor knows how to translate those motives into probabilities of success or failure. Reading numbers mechanically won't make you rich. Interpreting behavior through those numbers might. The biggest mistake new investors make is thinking they need advanced formulas to understand a company. They start memorizing ratios, margins, and complex financial models. But that's like trying to understand a person by calculating their body mass index. You get data, but you miss the essence. A good balance sheet reader starts by asking simple, powerful questions. Does this company make more money than it spends? Does it have enough resources to survive a storm? Does it treat capital with respect or with arrogance? The answers lie in how the numbers move over time, not in how fancy they look in one report. You can always tell a disciplined company from an impulsive one by looking at the stability of its financial structure. If assets are growing faster than liabilities, that's usually a sign of smart reinvestment. If debt is rising faster than earnings, that's a warning that management might be chasing growth without control. Every decision leaves a trace. A thoughtful reader connects those traces to form a pattern, and that pattern tells you everything about a company's character long before a crisis does. Simplicity is the greatest friend of the intelligent investor. The world of finance loves complexity because it hides ignorance, but simplicity forces clarity. If you can't explain a balance sheet in plain language, you probably don't understand it. When you look at a company's financials, you should be able to describe it as if you were talking to a bright teenager. If you can't say it simply, you're only fooling yourself. A company that's genuinely strong will have a simple and transparent balance sheet. A company that's hiding trouble will bury it under layers of technical accounting terms and creative adjustments. You don't need to decode hundreds of details. Focus on what matters most. Look at how much cash is coming in and how much is going out. Look at how much debt is being carried and whether that debt is sustainable. Look at whether assets are productive or just sitting idle. The human mind has a tendency to overcomplicate things, especially when it doesn't want to face the truth. But if you strip away the noise, what remains is usually very simple. A good business earns more than it spends, uses debt carefully, and grows its equity over time. A bad one does the opposite and then invents excuses to justify it. Simplicity also acts as a truth detector. When you keep things simple, dishonesty becomes obvious. Management can manipulate earnings for a quarter or two, but they can't fake a balance sheet for long. Sooner or later, the truth shows up in the numbers. That's why experienced investors love simplicity. It leaves no place to hide. Complexity, on the other hand, is often the first refuge of mediocrity. When someone builds a maze of accounting adjustments, subsidiaries, or obscure assets, it's usually a sign they're trying to disguise weakness. A truly great company doesn't need to impress you with complexity. Its performance speaks plainly for itself. The ability to simplify doesn't come from laziness. It comes from mastery. When you've studied enough businesses, you realize that all great companies share similar traits. Their balance sheets are clean, transparent, and easy to understand. Their capital structure makes sense. Their assets are productive. Their liabilities are manageable. Their equity compounds steadily. There's no magic, just common sense practiced consistently. That's why simplicity is a competitive advantage. Most investors get lost in unnecessary data, while the best investors focus on the handful of facts that actually matter. Understanding simplicity is also understanding where to direct your attention. If you spend your time reading too many small details, you'll miss the big picture. But if you focus on what drives long-term results, you'll start seeing patterns others overlook. For example, when you notice that a company keeps its debt level stable despite growing revenues, it means management is disciplined. When you see a company with rising inventories and declining cash flow, it might indicate weak demand or poor management of working capital. Simplicity lets you see these signals clearly without drowning in complexity. The beauty of simplicity is that it aligns perfectly with human nature. The average investor seeks shortcuts, complicated models, and predictions. But wealth in investing doesn't come from complexity. It comes from the ability to identify what's essential and ignore what's irrelevant. The best investors are not the ones who can build the most complicated spreadsheet. They're the ones who can make the clearest judgment using the fewest variables. The simplicity of thought produces clarity of action. When you read a balance sheet this way, you begin to see that numbers are just the outer shell. What matters is the meaning beneath them. You're no longer just analyzing, you're interpreting. You start understanding why certain companies thrive in chaos while others crumble. You recognize that every financial statement tells a psychological story about greed, discipline, fear, and foresight. Simplicity allows you to see the cause and effect that connects these traits to long-term success or failure. True mastery in reading balance sheets isn't achieved by memorizing every line. It's achieved by learning to think clearly. The investor who understands human behavior can learn more from one page of financials than a technical analyst can learn from 1,000. That's because the essence of business is not found in formulas. It's found in judgment. If you train your mind to look for simplicity and behavioral truth inside numbers, you'll develop an instinct that most investors will never have. A balance sheet is like a compass. It won't tell you where every obstacle lies, but it will point you in the right direction if you know how to use it. The key is not to let complexity pull you off course. If you keep your analysis grounded in simplicity and focused on behavior, you'll be able to separate illusion from reality. And in a world filled with noise, that clarity is worth more than gold. When you reach this level of understanding, reading a balance sheet becomes less of an accounting exercise and more of an art form. You start to feel the rhythm of a business, the rise and fall of its discipline, the strength of its foundations, the integrity of its leadership. Every figure tells you something about the mindset of the people running it. Some companies reveal honesty through conservative reporting. Others expose recklessness through inflated expectations. Once you train your eyes to see it, you'll never look at numbers the same way again. A professional reader of balance sheets doesn't just look for profits. They look for patterns of behavior that repeat over decades. They look for consistency in values and prudence in action. They understand that the real story is not written in the totals, but in the trends. Numbers change, but behavior repeats. That's what makes understanding the psychology behind the balance sheet so powerful. It gives you a lens that sees further than any formula ever could. And so, the real secret is not in what the numbers say, but in what they imply about the people behind them. The wise investor studies those patterns, filters out complexity, and focuses on the few facts that truly matter. When you can read behavior through numbers and keep your thinking simple, you've already learned to read a balance sheet like a pro. There is a quiet truth in finance that separates the great investors from the average ones. It's the understanding that cash is not just a number on a page, but the living pulse of a business. Many people obsess over earnings, revenue growth, or projections for the future, but all of that means little if there isn't real money flowing in and out with purpose and consistency. Cash tells the truth when everything else can lie. It doesn't care about accounting tricks or clever narratives. When you strip away all the noise, cash is the most honest indicator of whether a company can survive, adapt, and thrive. The amount of cash on a balance sheet is a reflection of discipline, judgment, and patience. A company that consistently generates and preserves cash shows you that its leaders understand not just how to make money, but how to keep it. Cash is more than a cushion against hard times. It is the ultimate proof of sanity in business decision-making. It reflects how carefully a company manages its inflows and outflows. When there is too little cash, you can almost feel the desperation behind the management's decisions. They borrow more, dilute shareholders, or cut corners just to stay afloat. When there is healthy cash flow, you see calm confidence in how they handle challenges. It's not an accident. It's the result of systems, habits, and philosophies built around sustainability instead of short-term excitement. The companies that endure are the ones that never allow the oxygen of cash to run out. Because in the end, no matter how strong the business model looks on paper, when the cash dries up, the business collapses. Many investors fall into the trap of confusing accounting profit with financial strength. A company might report impressive earnings but still run out of cash because of poor management or aggressive expansion. On the other hand, a company that generates stable cash flow even with modest profits often proves to be far more resilient. The difference lies in understanding that profit is an opinion while cash is a fact. It's one thing to say a company earned $10 million on paper. It's another thing entirely to see $10 million actually sitting in the bank. The ability to convert profit into real, usable cash is the hallmark of a well-run enterprise. Cash gives a company control over its destiny. It allows management to make decisions from a position of strength rather than desperation. When a company has strong cash reserves, it can seize opportunities others cannot. It can acquire competitors during downturns, reinvest in growth, or simply weather economic storms without panicking. Companies with weak cash positions have no such freedom. They live at the mercy of creditors and investors. That difference in flexibility is often the difference between those who survive and those who vanish during hard times. Every investor who studies a balance sheet must learn to see cash not as an isolated figure, but as a symbol of a company's resilience. A large cash balance, however, is not automatically a good thing. Cash that sits idle can also reveal something about management's mindset. Too much unproductive cash may signal indecision or a lack of attractive investment opportunities. The art lies in balance. Enough cash to ensure stability, but not so much that it reflects stagnation. The companies that excel are those that put cash to work intelligently, always maintaining enough safety while ensuring every dollar has a purpose. It's a fine line between caution and complacency, and the smartest investors learn to identify which side of that line a company stands on. When you study a company's cash position over several years, you start to notice patterns. Some businesses generate cash effortlessly, year after year, through strong operations. Others swing wildly between abundance and shortage, revealing instability beneath the surface. A consistent cash generator often hides deeper virtues, efficient operations, loyal customers, disciplined leadership, and a culture of restraint. These are not just financial traits. They are reflections of character. The cash figure you see on a balance sheet is the result of thousands of small, rational decisions made over time. When a company's management treats cash with respect, it almost always treats shareholders the same way. The next clue that reveals a company's true nature is its relationship with debt. Debt is one of the most misunderstood tools in finance. In the right hands, it can accelerate growth and create enormous value. In the wrong hands, it becomes a silent killer that destroys even the best businesses. During good times, debt can make a company look stronger than it really is. Leverage magnifies returns when things go well, but it also magnifies pain when things go wrong. This is why understanding the liability side of the balance sheet is just as important as reading the assets. It tells you who owes what to whom and how soon they need to pay it back. The balance between assets and liabilities is the true measure of stability. Debt is not inherently bad. It becomes dangerous when it is used without discipline. When a company borrows money to expand operations that generate consistent and predictable cash flow, that's a smart use of leverage. But when a company takes on debt simply to chase short-term growth, buy back shares, or cover operational gaps, it's a warning sign. You can always recognize this pattern by how the debt moves over time. If liabilities rise faster than revenue or assets, it means management is losing control. They're no longer using debt as a tool, they're using it as a crutch. The real test of a company's strength comes when the economy turns against it. That's when you find out who borrowed wisely and who borrowed recklessly. In prosperous times, everyone looks competent. But when interest rates rise or demand falls, only the disciplined survive. Those with too much leverage start selling assets, cutting staff, or begging for new capital just to keep the lights on. Meanwhile, the companies that manage debt wisely barely flinch. They continue operations smoothly because they plan for the worst even during the best of times. The difference between the two isn't luck, it's prudence. Debt also reveals management's temperament. A company addicted to borrowing often reflects leadership that can't resist the lure of rapid expansion. They want growth at any cost, but true business strength lies in patience and restraint. The best managers understand that borrowing is like fire. It can cook your dinner or burn your house down, depending on how it's handled. They don't borrow just because they can. They borrow only when the return clearly outweighs the risk. They understand that in the long run, survival is far more important than speed. When you read the liabilities section of a balance sheet, think of it as a map of hidden risks. Some debts are visible, like long-term loans or bonds. Others are buried in the fine print, such as lease obligations or off-balance sheet commitments. These hidden liabilities are like time bombs waiting for the right conditions to explode. A wise investor reads carefully and asks one question above all: can this company comfortably pay its debts even if the market turns against it? If the answer is no, then the company's apparent strength is nothing more than an illusion. The ability to use debt responsibly is what separates great companies from the fragile ones. The best businesses use borrowed capital as an instrument of strategy. They understand that modest leverage, properly managed, can enhance returns without threatening survival. But once the balance tilts toward dependency, the game changes. Debt becomes not a servant, but a master. And when the master calls, it takes control of everything. The balance sheet will always tell you where a company stands in that relationship. If you want to truly understand how a company behaves under pressure, look at what happens to its debt during a downturn. Companies that reduce leverage when times are hard display discipline and foresight. Those that increase borrowing in desperation show panic. Patterns like these are visible to anyone willing to read between the lines. Over time, they tell a story of how management thinks and how they react when reality tests their optimism. Cash and debt are two sides of the same coin. One represents security, the other represents risk. Together they reveal how wisely a company manages its resources. A company with abundant cash and minimal debt can navigate uncertainty with ease. One with little cash and heavy debt is always a single crisis away from collapse. The difference lies not in external conditions, but in internal choices. Every decision about cash flow, borrowing, and repayment reflects a philosophy, a set of beliefs about how to handle money, opportunity, and danger. Those beliefs are visible to anyone who studies the balance sheet with patience and clarity. When you view cash and debt together, you start to see the bigger picture. The goal isn't just to find companies with high cash balances or low liabilities. It's to find those with intelligent balance. Companies that keep enough liquidity to stay flexible while maintaining just enough leverage to enhance efficiency without risking collapse. It's a balance rooted in judgment, not luck. The balance sheet is simply a reflection of how that judgment has been exercised over time. So, when you read those lines of numbers, you're not just analyzing financials, you're decoding philosophy. You're understanding how the people running that company think about safety, ambition, and time. Cash tells you whether they respect reality. Market tells you whether they respect risk. Between those two, you can see the entire character of the business. And once you learn to read that character through the numbers, you stop guessing and start knowing. When you look at the asset side of a balance sheet, you are not just looking at what a company owns, you are looking at what kind of future it is building. Assets are the tools a business uses to generate cash, to grow and to survive. But not all assets are created equal, and that's where most people make mistakes. The balance sheet shows you what the company claims to own, but understanding what those assets truly represent requires deeper thinking. Some assets produce value year after year, while others sit idle, eroding in usefulness with time. The difference between a productive asset and a decorative one is the difference between a company that grows wealth and one that just pretends to. Many companies fill their balance sheets with impressive figures, showing massive totals under assets. But if you look closer, you might see that a significant portion of those assets are goodwill, intangibles, or deferred items that have no physical presence or immediate earning power. These numbers might look comforting on paper, but in reality, they can evaporate the moment confidence disappears. That's why great investors never stop at what is printed. They ask what those assets truly mean. Does the company own factories that produce goods? Does it own patents that generate royalty income? Or are its assets simply numbers inflated by acquisitions and optimistic accounting? The strength of a business lies not in how large its assets appear, but in how useful they are in creating real cash flow. A real asset produces something of value, something tangible that feeds the business, a manufacturing plant that runs efficiently, a distribution network that cuts costs, or a brand so strong it commands premium pricing. These are genuine assets. They are the kind that survive the test of time and the pressure of competition. On the other hand, a line item called goodwill might represent nothing more than the premium a company paid for buying another firm, often justified by promises of future synergy that rarely materialize. In tough times, goodwill and intangible values shrink, and suddenly what looked like a fortress of assets turns into a house of cards. When you study the asset side, look for productivity. Ask whether those assets are actively contributing to profit or simply resting there to make the numbers look good. Cash sitting idle on the balance sheet may look safe, but if it isn't being used efficiently, it's also a sign of management's indecision. Inventory can be a productive asset when it meets customer demand quickly, but it becomes a liability when it piles up unsold. Property and equipment are valuable only if they generate returns higher than their cost of maintenance. This is the level of thinking that separates a casual reader from a skilled investor. Anyone can count numbers, few can interpret their purpose. Another way to read the truth behind assets is by studying their relationship to revenue and earnings over time. If assets are increasing but profits are not, it could mean inefficiency or waste. It could also reveal that management is investing capital in areas that do not produce adequate returns. A business that constantly adds new assets without a matching rise in productivity is like a farmer buying more land, but growing the same amount of crops. Real progress is not in size, but in efficiency. The wise investor doesn't get impressed by the magnitude of assets. He looks for the strength of their performance. You can also tell a lot about management's integrity from how they value assets. Conservative management teams record their assets at fair value or even below, preferring to surprise shareholders positively. Aggressive or insecure management often inflates asset values to make performance appear better. The accounting world allows flexibility in valuing assets, but wisdom lies in restraint. When you see a company that habitually revalues its assets upward without showing corresponding growth in income, that's usually a warning sign. It often means they are trying to paint strength where weakness exists. The best balance sheets reflect humility, not vanity. Another detail often overlooked is how well a company maintains its existing assets. Depreciation is not just an accounting term. It's a measure of how responsibly the business cares for its tools of production. A company that spends wisely on maintenance and upgrades shows discipline. One that underinvests in upkeep while inflating reported profits is setting itself up for future decline. You can see this pattern clearly when capital expenditures fall below depreciation for several years. It means the business is consuming its own assets to make current results look better. A strong reader of balance sheets never misses that clue. When you move from assets to retained earnings, you start to see another layer of truth. This part of the balance sheet tells the story of how management has treated the profits generated over the years. Every dollar of retained earnings represents past success, but what truly matters is what the company did with those dollars. Did they reinvest wisely, building more productive capacity, stronger brands, and higher returns? Or did they squander it on vanity projects, overpriced acquisitions, or unnecessary share buybacks? The retained earnings line becomes a record of long-term judgment. Retained earnings are like the scoreboard of management's performance. A company might have earned billions over the decades, but if those earnings didn't compound into greater value, then they were wasted. The test is simple. Has retained capital produced higher earnings and better cash flow per share over time? If yes, then management understands how to allocate resources effectively. If not, then the business might be profitable on paper, but poor in wisdom. The art of reading retained earnings is the art of judging whether profits have turned into enduring power or fleeting appearances. Many investors overlook this section because it doesn't move much in the short term, but it's here that the real compounding happens. Over long periods, retained earnings show whether a company builds or erodes shareholder wealth. A business that reinvests retained profits into ventures that grow income sustainably demonstrates strategic vision. One that distributes every penny in dividends without reinvestment might please shareholders for a while, but it risks stagnation. Likewise, companies that hold on to profits but never deploy them intelligently often lose momentum. It's not about how much is retained, it's about how well it is used. One of the most revealing exercises an investor can perform is to compare a company's cumulative retained earnings over 10 or 20 years with its current net worth. If the value of the business has grown far beyond the total of retained earnings, that indicates management has multiplied shareholder capital effectively. If not, it shows inefficiency or poor capital allocation. This simple comparison often tells you more about management quality than any quarterly report ever could. The beauty of retained earnings is that they compound quietly. Each year, the business earns a profit, keeps a portion of it, and uses it to generate more profit in the next cycle. Over decades, this compounding effect becomes exponential. The companies that master this principle become giants without needing to constantly raise new capital or rely on external financing. They grow from within, using their own success as fuel for more success. When you find such a company, you found a rare gem. But there's a hidden warning in retained earnings as well. Sometimes management holds on to profits not because they have great reinvestment opportunities, but because they lack the courage to return capital to shareholders. They convince themselves they can deploy the money better, yet their actions prove otherwise. Year after year, they keep profits but deliver no real growth. That's when retained earnings turn from an engine of compounding into a pool of stagnation. Reading this requires judgment, the ability to distinguish between wise accumulation and mere hoarding. What makes retained earnings so powerful is that they reveal time's verdict on leadership. They show how decisions made years ago have shaped the present. When you track retained earnings over long periods, you begin to see the rhythm of success or failure repeating itself. Companies that understand capital allocation create wealth naturally. They don't need luck or hype. They just follow the discipline of reinvesting wisely and letting compounding do the rest. Those that fail usually do so because they misunderstand what real growth is. They chase appearances instead of substance, spending retained profits on short-term boosts instead of building long-term strength. If you study the best companies in history, you'll notice that their growth is not just the result of innovation or marketing. It comes from intelligent use of retained capital. They treat every dollar as if it were their own, putting it where it earns the highest long-term return. They expand when opportunities justify it and hold back when they don't. They know that patience compounds as powerfully as capital. The retained earnings line tells you whether that patience exists. It separates those who think in quarters from those who think in decades. The key is to see beyond the figures and into the philosophy that produced them. Assets tell you what the company owns today. Retained earnings tell you what it has built over time. Together they reveal the quality of thought guiding the business. When you understand that, the balance sheet stops being just a record of numbers and becomes a story of intelligence at work. Some stories are filled with wisdom, discipline, and long-term success. Others are filled with vanity, overreach, and decline. But the truth is always there, quietly written in the assets that produce and the earnings that endure. When you look at any great company, what separates the truly enduring ones from the rest is not the products they sell or the speeches their executives give. It's the silent honesty of their numbers. The numbers never lie, but they do reveal character in a way most people overlook. When you judge a company, you don't need to hear what the managers are promising. You only need to see what the balance sheet quietly confesses. Because in those numbers lies the truth about how they think, how they act, and how disciplined they are when no one is watching. The language of business isn't written in fancy words or PR statements. It's written in assets, liabilities, cash flow, and retained earnings. Anyone can sound intelligent in a meeting, but only those who act rationally leave a clean and consistent financial trail. When you read the numbers, you're really looking for evidence of integrity. Look for companies where management behaves conservatively with leverage. Debt is not evil by itself, but reckless debt is the first sign of poor judgment. When a company borrows heavily just to grow faster or impress investors, it is revealing impatience. A great manager uses debt as a tool only when it's cheap, safe, and productive. The cautious manager knows that every dollar borrowed is a promise that must someday be kept, no matter how the market turns. Watch how they reinvest. Are they buying back stock when it's expensive just to boost short-term prices, or are they reinvesting profits into projects that actually create more long-term value? Numbers don't lie about that. You can also sense management's temperament from how they handle cash. Do they let it pile up when the world is uncertain, or do they spend it all in the name of growth? There's a pattern you can see if you look long enough. Good managers treat cash as sacred. They know that having a war chest in tough times is what allows a company to survive and take advantage of others who panic. The ones who always run near empty, betting on the kindness of markets, are not truly confident. They're gambling on optimism. When markets fall, their weakness is exposed. Reading the cash section of a balance sheet is like reading a person's diary. It tells you what they value, what they fear, and how disciplined they truly are. There's also a difference between managers who talk about shareholder value and those who actually build it. Look at how equity grows over time. If a company's equity per share keeps increasing steadily while avoiding unnecessary dilution, that's usually a sign of honest stewardship. If you see sudden jumps from acquisitions followed by stagnation or decline, you're probably seeing empire building, not value creation. The balance sheet records all those habits. Every merger, every dividend policy, every repurchase decision leaves fingerprints. Your job is to read those prints carefully and ask what kind of person would make those decisions. The beauty of this approach is that you don't need insider access or secret knowledge. The truth is sitting there in public, available to anyone willing to look past the headlines. When managers say one thing, but the numbers show another, believe the numbers. The person who reads financial statements with curiosity and skepticism will always understand more about the company's future than the one who only reads press releases. This is how you learn to think independently in a world that rewards conformity. The goal is not to find perfect people, because there are none, but to find honest patterns of thought. The numbers are where those patterns live. When you start to develop this skill, you'll notice that great companies often look boring. Their balance sheets are tidy, their leverage is low, and their retained earnings compound quietly year after year. They don't chase trends or issue wild forecasts. They are not run by gamblers, but by steady hands who understand the slow compounding of rational behavior. In contrast, flashy companies that always have an exciting story tend to have messy balance sheets full of goodwill, intangible assets, and unstable cash positions. The story sounds beautiful, but the math whispers a warning. Learn to trust the math. Reading numbers this way is an art of quiet thinking. You are not trying to outsmart anyone in the short term. You are trying to see through the noise and find the truth. You train yourself to think like a judge rather than a cheerleader. You want evidence, not emotion. The numbers are your witnesses. They tell you whether the business is run with prudence or vanity, whether its leaders are builders or dreamers. The more you practice, the easier it becomes to spot the difference. Once you learn to judge management by what they do instead of what they say, you develop a rare advantage. You stop falling for hype. You stop confusing charisma with competence. You stop being impressed by buzzwords and instead focus on results that can be measured. The balance sheet becomes your filter, and through it you separate real value from illusion. It's not glamorous, but it's powerful. The market eventually rewards those who stay rational when others chase excitement. The next step is learning how to act once you've seen the truth. Reading balance sheets is only the beginning. What you do with that knowledge defines your success. This is where patience, discipline, and courage become your greatest allies. Most people read financial data to make quick decisions. They want action, not understanding, but true mastery comes from slowing down. The mind that reads slowly sees more. Patience allows you to connect the dots others overlook. You can think of patience as a mental filter that keeps you from acting on impulse. When you read a balance sheet, your goal is not to decide instantly whether to buy or sell, but to absorb the logic of the business. You want to see how its assets, liabilities, and earnings evolve over time. Only then can you judge its real trajectory. Great investors train themselves to wait until the facts line up perfectly before they act. That discipline keeps them safe from the emotional storms of the market. But patience alone is not enough. You also need the courage to act when your analysis gives you conviction. It's easy to wait. It's harder to step in when everyone else is panicking. The ability to make calm decisions in chaos separates those who survive from those who thrive. Reading balance sheets builds that confidence because it gives you something solid to stand on. When you know what a company is truly worth, you're not afraid of temporary price swings. You understand that value doesn't disappear just because others are scared. Discipline comes from repetition. The more you study balance sheets, the more patterns you begin to see. You start recognizing signs of strength, consistent cash growth, modest leverage, rising retained earnings and warning signs, swelling liabilities, shrinking equity, erratic income. Over time, your brain becomes trained to spot both excellence and danger almost instinctively. That's the reward of patience, a calm, automatic sense of judgment built through experience. This discipline also protects you from overconfidence. The market has a way of humbling everyone eventually. That's why discipline must be grounded in humility. No matter how good your analysis is, the world can always surprise you. The disciplined investor never bets the farm. He or she always keeps room for error. Reading balance sheets is not about being certain. It's about being prepared. You want to be approximately right rather than precisely wrong. The courage part comes when the facts align, but the crowd disagrees. That's when rationality feels lonely. Acting with courage doesn't mean taking reckless risks. It means trusting your logic when the data supports it. When you've studied a company's numbers, understood its character, and seen how management behaves in both good and bad times, you develop the conviction to act while others hesitate. That's how fortunes are built quietly while the crowd is still shouting. Thinking in this way also keeps your emotions in check. Fear and greed are the two forces that destroy most investors. But when you base your decisions on disciplined reading of balance sheets, you're no longer swayed by them. You become detached, analytical, almost clinical. You don't chase rallies or panic in sell-offs. You're guided by evidence, not noise. The balance sheet becomes your compass in a storm. Over time, this habit of patient, disciplined reading transforms your entire mindset. You begin to see businesses as living organisms with habits, strengths, and flaws. You stop reacting to prices and start studying causes. You begin to understand that long-term success is not about timing markets, but about understanding value. Each balance sheet you read sharpens your intuition and deepens your understanding of how the world works. The market always rewards those who think clearly when others think emotionally. Patience, discipline, and courage are not just investing virtues. They're life virtues. They protect you from the madness of crowds and give you a framework for rational decision-making in every situation. Reading balance sheets the right way trains you to think about the long term, to focus on fundamentals, and to act only when reason tells you to. The great secret is that this approach is not complicated. It's just hard because it requires restraint. Most people can't stand waiting, can't stand uncertainty, and can't stand being wrong. But if you can read the truth from the numbers, stay patient through the noise, and remain courageous when opportunity finally appears, you will end up far ahead of those who tried to shortcut the process. It's not brilliance that wins in investing. It's rationality practiced consistently over time